Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Monday, it's the 29th of May. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. Can I just double check that you guys can hear me, see the screen, and see me? There were some technical issues on Friday. I just want to make sure that we are okay to go this morning. You can just type in a Y, just to let me know that you can hear me. I'd appreciate it. I'm going to bring up the high-risk investment warning in the meantime. I'll keep this on screen for a few moments. Hey Anna, good morning to you. Hey Gurdeep, all right, thank you very much for letting me know. All right, that makes me feel better. Sorry about Friday, I just couldn't get the sound to work. Here's the market commentaries disclaimer. I'm going to keep this on screen for a few moments. Today is going to be a very slow day. One would expect in the markets. There are public holidays in Europe, there's public holidays in the US. So just be aware of that. I think that liquidity is going to be thin today. All right, in terms of our references, MarketScope, TradingView, and I've added the CME group. Let's just go through to TradingView first. And we had the core PCE print come out on Friday. And it actually came in hotter than expected. It was anticipated to be at 4.6, came in at 4.7. And this rate of change here, so this is a rate of change of a rate of change, which is effectively measuring, excuse me, acceleration, deceleration, when it's bumping back towards zero. That's troublesome. That's troublesome. The target you can see is 2%. We're at 4.7%. To get us down to 2%, the rate of change of the rate of change has to remain on the deceleration side of zero, and it's turned. It's headed back towards zero. So we, excuse me, so we're right in the midst of a very sticky type of inflation. And what has effectively happened, if we take a look at the Fed Watch tool over here, the June meeting, which is due on the 14th of June, and we'll get the announcement, there's now a 62% chance that we're going to get a rate hike from the range of 500, 525 to 525, 550. And just 1 week ago, that was 25%. So you can see that inflation print that we got on Friday has made a world of difference. And it looks as if we're going to get this 25 basis points coming in around about 2 weeks' time. Now, the next piece of data that we have to monitor would be the non-farm payrolls. So the non-farm payrolls come out on Friday. We'll be doing a live trade there. So if you can just check in the chat, I've pasted the link for that live trade on Friday. But it has shifted markedly on the CME Market Watch tool, and it does look as if we're going to get this this interest rate hike come the 14th. Hey Raj, morning to you. Nice to have you on the webinar. All right, let's just bring up the US dollar here. Because it's going to be such a quiet day, what we'll do is we'll just try and get a sentiment reading for most of the instruments. But what's interesting is that the US dollar is sitting slightly overbought. So it's unlikely that we're going to be able to stay overbought for long. But we are in zone one. So what I would do is I would watch this very carefully, see if when the normalization ensues, whether or not it can stay in zone one. I would expect the dollar is being supported by the fact that there's going to be a rate hike. And if that's the case, any of these pullbacks over here, one would just need to watch carefully. So this is a tricky chart that we're looking at right here. In effect, we've got this pullback in the US dollar H1 chart. It's heading towards S1. Sorry, my system's just hanging a moment. All right, let's just bring up trading view. So if we go through to the US dollar, if we go down to the hourly, okay, we've got a support level coming up right at this S1 level. Okay, so that's what I wanted to show you. Let's just see if it's, yeah, there we go, it sorted itself out. So here's that support level. It looks like a pretty decent support level. So let's just talk about the sort of pros and cons here. The pros are that there is support for this on a fundamental, support for the US dollar on a fundamental basis, is that there's a repricing in the futures market in that the 14th of June, whereas we expected a pause, now there seems to be the chance of a 25 basis point hike. Given that the S1 level becomes quite an interesting level, it's got support 1, support 2, support 3. So it's been touched a number of times here. The one issue that I'm having is that it's overbought. So it makes for a very tricky market. In terms of what this RSI is in our system effectively for, is to show when the risk reward profile is skewed. And I'm afraid it does seem as if the risk reward profile does look as if it's skewed at the moment. So any sort of bullishness that comes in at the S1 level, I would just urge you to be very cautious, because we've got this overbought condition. Now, again, this is going to be a very quiet day. I would expect a very quiet day. We've got Whitsundays, we've got a summer holiday, the summer banking holiday, and we've got Memorial Day. There are, did I say Whitsunday? Whit Monday, I beg your pardon. Whit Monday, Memorial Day, Summer Day. All of these are banking holidays that are going to curb liquidity. So in terms of any sort of real movement over here, we may get a delay on that until tomorrow. If we go through to the daily, the weekly chart, what we want to do is just get some sentiment readings here, because it is banking holidays in a few regions here. Let's just try and get an idea of what's happening with our sentiment. And the way we're going to do that, so on a Monday, what we've been doing is just turning the last 2 candles, not counting this week's candle, because this week's candle still got a lot of days ahead of it. But the last 2 weeks' candles, what we're going to do is combine that into one, and we're going to get the the candle that it the combined candle. So if we take the range of the candle 2 weeks ago. Okay, so we're taking this candle and we get the low, and we take last week's candle, get the high, and we just draw those together. We get this type of a range. Then where's the open? Well, the open would be the open from 2 weeks. Where's the close? The close from last week. And you can see we're actually getting a very bullish candle here. A very bullish candle. And what I can do is I can actually shade this in. Make it green. So you can see the dollar over here. If we have to combine these 2 candles, gets a nice long in effect, I'm going to just exaggerate it to show you. It's looking something like this. It's really a nice bullish sentiment. So let's just understand what we've talked about here. We've got the weekly combined looking very bullish. We've got the underlying fundamentals, which seems to be suggesting because of the sticky inflation, well, the dollar as a safe haven, the dollar as just being supported by higher interest rates, seem to be supporting the technical combination of these two candles. And if that is the case, obviously we want to look to see how compelling the shorts are. What's the one problem here? The one problem is this overbought. Now, because we tend to look at the dollar first, in my opinion, the dollar is where the analysis starts. Because the dollar is showing positive signs, but albeit with an ambiguity, because I think that this has to clear, I think they're actually going to ripple through to the other instruments in the market. So if we take a look at other instruments, let's just bring up the euro over here, do a similar type of analysis with the euro. All right, so you've got, let's combine these two candles here. So we're going to combine this candle, and we're going to combine these two candles. So we're going to get the high from 2 weeks ago. We're going to get the low from last week. Let's just draw that in. I'm going to try and exaggerate it just to get the idea. Where is the open? The open is over there. Where is the close? Close is way down here. So we're getting a very bearish looking sentiment here. Something like this. And I want to make this green, I want to make it red. It's a red candlestick. And then let's just exaggerate it more, just to get an idea of the sentiment. Let's make this red. Yeah. So you can see that we've got this red combined candle. Take a look what's happening to the weekly momentum. Weekly momentum has dipped below 50. So there is the suggestion of a euro that's under pressure, okay, just in terms of the combination of the sentiment, right? Now, there is some blue that's starting to peek in here. So is there a potential opportunity to look for resistance levels? And again, the R1 level here would be your logical level to look at. That corresponds with the S1 support for the dollar. If the S1 support for the dollar holds, one would expect the R1 resistance level to hold for the euro. So it does look as if we're getting a good setup here. What is the problem? What is the problem? The problem is the US dollar. The problem is the US dollar. So again, this is where the caution needs to come in, because we've got that overbought condition on that US dollar. Again, the RSI is specifically put in to protect us in terms of letting us know when there's a skew in the risk and the reward. And it would be foolhardy of us not to pay attention to the fact that the RSI has in fact started to give us that signal. So even though the sentiment is looking positive for the dollar, negative for the euro, even though the hourly charts show that there's support, underlying support for the dollar at S1, even though the resistance for the euro is showing that there's overhead resistance, I would again urge you to be cautious, because the risk reward profile is starting to skew. What does that mean? It means if you choose to go ahead with any sorts of trade, one must, and this is typical, one would do this with every trade, but again, I just want to emphasize the use of stop losses here and the use of risk management. All right, let's just take a look at the DAX here. The DAX is setting up to open. Okay, similar sort of analysis here. Now, this is going to be an interesting chart to analyze. All right, let's just bring in our arrow. I'm going to combine these two. This is very tricky. It's a different candlestick. So let's take the high and let's take the low. Okay, let's draw that in. Where's the open? The open would be here from 2 weeks ago. Where would the close be? Look at this. Close would be here. We've got a doji. So the DAX is actually showing us uncertainty. It's showing uncertainty. Now, we have got this thick band of support over here. And I say thick band, remember this is a weekly chart. Okay, and it's been supported over 1, 2, 3, 4, 5, 6 weeks. We do have higher trough followed by higher peak, followed by higher trough, followed by higher peak. Now, this is where I think it gets really interesting. Okay, how does Germany officially entering technical recession affect the DAX? Well, I think that it's added to the fact that we've been moving sideways in the DAX for the last 5 weeks. So, whereas it's had a very smooth higher trough, higher peak, higher trough, higher peak, that's not really the case anymore. It's that the fact that it started moving sideways here. So I think that the technical recession here has certainly perhaps added a headwind to the DAX. But what I think is interesting here is that we may be getting a surprise whipsaw, Anna. So here's our squeeze. We've spoken about the squeeze before, okay? And it looks as if there may be some sort of fake out. So I'm saying that we've got to be very savvy when it comes to the DAX. It looks as if the fake out pushed us into zone 3, and it often happens with squeezes that we get sort of these whipsaw signals. And now it looks like it's starting to make its way through to zone 1. Now, if it makes its way to zone 1, we're going to have a very interesting sort of analysis here. And I'll tell you why. Number 1, because Germany's entered a technical recession. Number 2, the interest rate environment's also acting as a headwind. So I think that the squeeze over here is still something that is going to be tested. And I want to see if we can get into zone 1 and get some sort of expansion in the Bollinger Bands here. And you can see that the momentum is pushing back into 50. I think the fact is that there is still a lot of interest in the DAX. I think the reason that there's a lot of interest in the DAX is because of diversification of portfolios. So what tends to happen is that we've got a technical recession happening in Germany. We've got a technical, we've got a potential recession happening in the US at the end of the year. Well, one way to protect your portfolio is to diversify. And the DAX 30 may be an instrument that is being used as a diversifying index for international monies. So we just want to see if the flow gets us back into zone 1. At the moment, we're in no man's land. That makes sense because we've got a doji when we've combined these two. So there's an uncertainty around the DAX. Not surprising, there's an uncertainty around the DAX. Just at the exact time we get told that there is a technical recession. Does that answer your question, Anna? I hope it does. Are there any other questions? All right, guys, just remember it's going to be, I think it's going to be a very quiet day. My opinion is going to be quiet just because of all the public holidays. I think liquidity is going to be thin. Please bear that in mind. Let's wrap up here. Remember that the live trade for the NFPs on Friday, the link is in the chat. I'll be posting it again throughout the week. I'm going to wrap up here. Have a very good day ahead, a very good evening. We shall chat again tomorrow morning. Thanks very much, guys.